Best financial year for stocks ever. Telstra shareholders in for some real money, and Deloitte accountants sending their workers home forever. I'm Peter Switzer.
I'm Paul Rickard.
And we're mad about money. Now, obviously, we're doing this masked up and in our office, but socially distanced and doing everything right. But we are essential workers, Paul, aren't we?
Almost.
Almost. Here we go. So the best year for financial stocks, financial year stocks forever.
Yeah, no, the market up this financial year, 23.7%. Added in dividends, Peter, that's over 27% return. Should go up a little bit today, possibly. You haven't been long shares in 2020, 21. Well, I'm not sure. You're a dope, right? Because
you've taken the doomsday date messages,
yep,
and they were wrong. They were wrong on house prices. They were wrong on stock prices. One day they'll be right, but timing is pretty important.
Timing is everything, but that's a great return. And the question is, can we do the same in 21, 22?
No, we can't. No, we can't. We can go up. We can't do 27 or whatever percent you said.
Yeah, 27%. So look, a fantastic return for being long equity. Stay with it. The trend is still your friend. But I think more likely a good return next financial year will be something like about 5% in capital and maybe 3 or 4% for dividends. But who can sneeze at 8% when term deposits are just 0.3?
And we also should throw in, I guess it's fair to say, that if there's a curveball out there for stocks, it will be that this Delta variant. And does it mean that if, for example, Europe and the USA, they're confidently going back to footy matches and back to rock concerts or whatever, that might bring them undone. But that's going to be the big watch. But certainly, let's enjoy the good times when they roll in. And let's go to the next big story. Telstra shareholders got some good news for a change.
Yeah, this is announced this morning. It's been in the wind for some time, I guess, Peter, because it was the reason why Telstra went through a structural separation. It broke its business into three. The most obvious asset is the so-called infrastructure asset. These are the towers. These are the mobile towers and other things.
The towers that we enjoy the fruits
we don't like in our own backyard, but we want to get the signal, right?
That's
Otherwise,
right.
we can't use the mobile phone or the broadband, whatever it is. Yeah. But they've sold 49%, which values the towers, the business worth, I think it's $5.8 billion.
Extraordinary.
And of that amount that Telstra keeps, which is about $2.9 billion, they're saying about 50% will come back to shareholders next financial year by some type of capital action. Most likely a buyback to be announced with their August 22 results. So, it's worth about that $2.9 billion, which is half of the amount that's, the $1.4 billion that they're going to give back to shareholders, Peter. That's worth about 12 cents a share. But when that's all be handed out in something like an off-market buyback, where only a small number of shareholders participate, it'll be worth a lot more. Yeah. And that'll be really good for low rate and zero rate taxpayers. So that should keep the Telstra share price heading up, well supported. We always knew there was more bit money in Telstra, but the challenge obviously for Telstra is still to grow earnings. And that's the bit that still the jury is out on. But what you have seen with the Telstra share price, and you and I have written frequently about this, saying you could get about 370, 380, is it's been going up very steadily. Yeah. And no reason to sell. So if you're long Telstra, hang on, enjoy the ride.
And the CEO, Andy Penn, has had a nice win. And he is, I think, a chartered accountant that's starting to show as he goes through the costs.
Well, I think the other thing from Telstra, of course, is the merger between TPG and Vodafone, Peter, which is sort of taken care of. It made 4 competitors into 3, and
TPG was probably a more aggressive competitor.
It was an aggressive competitor. It looks like the Vodafone people are on top, and the market is being a bit more rational. So bad for consumers, good for shareholders. But big news out of Telstra this morning.
Well, the big news also is that Deloitte, this is a very conservative accounting firm, is going kind of techie, isn't it? It's saying to its workers, you can work from home, you can choose how many days you come in, you can do anything you like. Basically, we're going to look at your output, not your inputs.
Yeah, are they just copying Atlassian, Peter? Of course, Atlassian building this beautiful new tower in Sydney, which is, but of course, it's
no one's there.
No one's there. It hasn't been built.
Well, why are they building if no one's going to be there?
Well, because the idea is everyone doesn't have to come to work, but don't come to work at your own peril. But it's interesting, Deloitte following suit, because in the tech world, there's a lot of pressure from a lot of the. I've seen it in a couple of businesses I'm involved with, Peter, about people who just want to work from home. Yeah. And I think this is and the labour market is really tight.
Yeah.
So, and the accountants, professional bodies, groups like Deloitte and Ernst & Young and those sort of people, they're under as much pressure to find staff as are some of all the companies trying to do a lot of work on digital.
Yeah.
So labour is tight, and you've got to be seen to be super staff friendly at the moment. So,
Yeah.
but you're right, it has a big impact long term for CBDs across
Yeah,
Australia.
so CBD businesses will be affected. The value of office blocks has to be affected. And I think there's going to be a big shift where developers will start looking at office blocks as a residential apartment. Because that's the only way the CBD and the retailers in the CBD will remain alive and healthy. They got to get new customers in, other than the office workers who've been there during the day, 5 days a week. They get new people in. And I think that will actually happen, but it'll take time.
I'm not prepared to give up on offices just yet in terms of companies.
Investments.
Well, in terms of companies wanting their staff to be in the office, clearly everyone's going to be a lot more flexible because that's the trend. But I'm just not convinced that the market has fully priced this in, because they'll tell you, if you look at the property trust market, it's all about the cap rates. They haven't moved too much. I'm just not sure we're really seeing the impact of this virus play out. When you get a big company like Deloitte saying anyone can work from home permanently,
Yeah.
that's a big change. So I think you're right. This is big news, and it is catching on, and a lot of companies will join the Me Too parade.
Yeah.
And what our CBDs look like, as you say, in the next 5 years, I think it could be very different. You're right. There will be more people living in. Just what that means for a lot of, the valuation on prime, CBD offices, I'm just not sure that has fully played out in the market. So my caution, I'm just still nervous of the office trust market. I just don't think it's all priced.
Yeah, me too. I'm Peter Switzer.
I'm Paul Rickard.
And we're mad about money.